Hey gang, if you've been watching the previous videos, you already know that we have spent a great deal of time talking about inventory. Now we're going to focus on another crucial asset that all companies must utilize in order to generate revenues: accounts receivable. In this video, I'm going to give you a nice introduction of accounts receivable and what things to expect to account for when dealing with that asset. But first, bags. So I want to take some time out first to connect the dots with the method to the madness that these companies are doing. Regardless of what company we're dealing with, right? The companies always are doing the same thing. They're chasing the bags as well.
It's payday, fellas!
And when they're trying to chase the bags, they're trying to generate cash. Now, the majority of the company's cash flows will come from the services being provided or the products being sold. We know when those events take place, that is actually earning revenue. Sometimes we provide a service or sell a product and receive cash simultaneously. Sometimes we don't. If you have a company and you're just providing services or selling products on a cash basis only, meaning that your customers will only be able to give you cash up front for the product being sold or the revenues being provided, you are ultimately limiting some of your revenue stream. And how is that? Because you can possibly set up an opportunity for your customers to pay you later. That opportunity means that you will be providing a service or selling a product on account. If that opportunity exists, you must create accounts receivable. And we know that accounts receivable is an asset, one of the very important ones, because of that fact. It allows us to increase our revenue streams. However, just as accounts receivable could be considered a blessing, it also could have a curse attached to it. Whenever we provide a service or sell a product on account, we're ultimately slowing down our cash flow stream because we're allowing the customers to pay us at a later time. That cash could be used to buy more inventory or operate, like pay off expenses and current debt. Another disadvantage of accounts receivable is the mere fact that you might not even get your money back. They might run away on the plug. And if that happens, we consider that to be uncollectible. So, accounts receivable has a level of uncollectability on the cash in the future depending on certain customers. But for the remaining time of this video, I'd like to introduce how to properly account for those uncollectibles. And so when we talk about uncollectability, the aspect of not collecting cash from your accounts receivable, there are two methods in which we could account for such an event: the allowance method and the direct write-off method. And so, gang, I like to always introduce the allowance method with a one-word definition. The allowance method basically estimates. And when we say estimate, we mean predict. And what are we predicting under the allowance method? We are estimating the amount of uncollectability. That uncollectability is represented as an expense to the company, a bad debt expense. Some companies call it an uncollectible account expense. So it just depends. The allowance method properly estimates the amount of uncollectability, or that portion that you won't be able to collect from the accounts receivable. That particular amount that won't be collected from the accounts receivable is considered an allowance for uncollectible account. That account is also a contra account to accounts receivable. Therefore, the allowance for uncollectible account affects accounts receivable negatively on the balance sheet. It actually helps you calculate the net realizable value. So when we talk about the net realizable value, we basically mean the amount that you expect to collect, which consists of the gross amount in accounts receivable minus the allowance for uncollectible accounts. And so there are two ways in which we could properly estimate uncollectibles under the allowance method: percentage of sales and percentage of receivables. And we're going to talk about all of those bells and whistles, gang, at another time. but I just wanted to give you an introduction of the allowance method. In contrast to the allowance method, we also have the direct write-off method. And unlike the allowance method, the direct write-off method doesn't do any estimates. What the direct write-off method does is basically waits until it comes the point in time to actually directly write off the accounts receivable. So when we're talking about writing off an accounts receivable, we basically mean that we are removing that portion of the accounts receivable that we can't collect off the books. Almost like the snap for Thanos, right? It is no longer in existence.
You are an old man and a fool!
And so what the direct write-off method does is take it away off of the books directly without making an upfront estimate about what we would expect not to receive, like the allowance method. So those are the two methods that we can choose and utilize in how to account for uncollectibles. Now, because the allowance method gives a more appropriate expectation of what to collect on accounts receivable on a balance sheet, it is highly preferred by companies to use the allowance method. However, the direct write-off method can be useful to some companies as well. So hopefully you have a great understanding of why accounts receivable is so important to companies and some of the pitfalls that companies may face when utilizing their accounts receivable. And if that light bulb was clicking, as always, gang, don't forget to like, subscribe, and share the channel with your friends so they can chase the bags as well. It's always a pleasure to have you guys spending time with me, and I look forward to seeing you all soon. Bags!